Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. The recent moves lower since mid-August had been mainly captured within a couple of bear channels. However, the influence of the, let's be frank here, optimized February to October head and shoulders neckline, currently at 1249, has had initially a tempering effect on the move lower and most recently a disrupting effect on the move lower, even though the neckline itself is bearish. If there is a single incident, let's say if there's a couple of incidents that have seemingly disrupted the move lower and now turned the market back around and started to head higher, well, I think you could lay one incident definitely at the door of the large combined key reversal up and bullish engulfing pattern made on Tuesday last week. Now, the action that day did penetrate the then overhead 50% Fibonacci line of the 2019 to May 2021 move at 1229 and one of the upper bear channel lines, currently at 1220. However, prices did not close over either of them. Yet by the Friday of that week, the market had indeed closed over both of them, as well as the 50% Fibonacci line of the April 2020 to May 2021 move at 1243. Then came the second incident. That was a further cause for a move back up. The gap up over last weekend. It is less than half a cent, really, but it is a gap higher, and from Monday the market has broken not only the second of the two bear channel lines, currently at 1259, but also closed over consecutively the short medium moving average, currently at 1257. The first time that's happened since mid-June. Yesterday prices reached up in a fairly free area to halt at the slowly declining medium moving average, currently 1302. That's the next obstacle overhead. Additionally, all the action over the last 2 weeks has put the market on the verge of a major new pattern, a monthly key reversal. The monthly key reversal up, that is. That's right, with a week and a bit to go, having achieved the criteria for a monthly key reversal up. So, if we close on Tuesday the 30th, either over 1266 or under 1249, then we'd be on. Right now we are looking at a monthly key reversal up for November. Additionally, all this action puts on notice of retirement all the following targets below. Target X2 in the 1175 area, the target for the really messy looking bearish halfway hesitation from early to mid-June. Targets X3 and X4, the primary and secondary targets for the optimized February to October head and shoulders top. Thus, with all these on notice, we now have to look to the top side and see what we may have ahead. And so I would now suggest looking at the slow declining long moving average, currently 1372, that sits above the medium moving average. Chicago soybean meal. I wrote some 18 weeks ago now, and I've repeated it ever since, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." Now, what I wanted to emphasize back then and every time since was that everything since May has been in the shadow of that singly bearish pattern. However, this relationship has started to break down 2 weeks ago when the market started to breach the short medium moving average, currently at 334 even. It was further disconnected when last week prices moved up clear over the short medium moving average, and especially last Friday when they closed clear up over the medium moving average, currently 344 even. This week the link was finally snapped when prices punched up and closed over the upper tine, currently 359.40 of the key bearish 2021 Andrews pitchfork. This has obviously not put on retirement the one remaining target below, target X2, the secondary target for the July to August descending triangle. This will be retired by my next commentary. This week has also seen a challenge to a significant overhead resistance patch, encompassed by the slowly declining long moving average, currently at 375 even, and the 50% Fibonacci line of the August 2020 to January 2021 move at 376.70. This has so far halted attempts higher, but I suspect we will likely see further attempts, and I'm not inspired by those two resistances given what has just taken place. Beyond these two on the upside, we will now have the 50% Fibonacci line for the whole of 2021 at 390.40. Chicago soybean oil I should say. For months now I've highlighted the rather lopsided diamond pattern seen back in May to July. Looking again today, I still find it being very influential pattern, though with some other smaller patterns, in most cases competing patterns. A few words again on this diamond pattern. Now, diamond patterns can be tops, bottoms or continuations. In this particular case it is, or rather was, a topping pattern. Back in July the market broke down through the lower trend line but did not immediately follow through lower. Prices finally dropped in late July and early August, halting for a while by the medium moving average, currently 60.66. By the middle of August, prices overcame this obstacle and continued their journey lower through the congestion zone between 57.64 to 59.44, which you can see as a stripe band across the middle of the daily chart, and punching down through the lower trend line of the July to date descending wedge pattern. The market tried exploiting this breach, but all that was managed was an additional, if short, bear channel over mid-August to late September. 8 weeks ago the market met a fresh pair of obstacles below, which couldn't be overcome. They were the rising long moving average, currently at 58.75, and the 50% Fibonacci line for the whole of 2021 so far at 55.43. However, the market still tried hard to overcome these, but with no avail, so in disappointment prices moved back up again. Though the new small bear channel, then the top of the descending wedge pattern gained momentum, moving up over the previously mentioned congestion zone between 57.64 and 59.44. In this last process, the market punched up and over the flatlining short medium moving average, currently 59.19, and the slowly declining medium moving average, currently 60.66. 4 weeks ago prices peaked up over the medium moving average with a pipe top before heading back down again, such that for nearly 2 weeks now we've seen the market challenge the congestion band 57.64 to 59.44, and also the rising long moving average that's within it and slowly rising up out of it. It has been a difficult time. Now, going back for a moment to that original descending wedge pattern from July to September, I placed a potential target X2 in the 66.80 area for this pattern's move. Now, I knew when I placed it, and again today, that this was and is a big ask, and I did point out repeatedly that unless this was a false break higher, then this is what the potential target would be topside. Well, so far the market's taken its own sweet time about coming up to target X2. However, now that the long moving average is mixing in with the congestion area below, it may well prompt a suitable response higher. We shall see. That is what it looks like right now. A lot of support right in here where the market is, and some hard to win opportunities above if the market is so minded. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.